Welcome to this explainer. Today, we're unpacking exactly how a massive, complex enterprise software company is taking the AI revolution and turning it into an absolute financial engine. If you've ever wondered how the back office of a Fortune 500 company actually functions and how AI is totally rewiring that reality, well, you're in exactly the right place. Let's get right into it.
We're kicking things off with a pretty dramatic question. Is AI going to destroy enterprise software? This is the exact question that triggered the SaaSpocalypse panic on Wall Street back in early 2026. The fear across the market was just absolute and palpable. Consider this massive 60% peak-to-trough drop for ServiceNow stock. It perfectly highlights that intense knee-jerk fear from the market. Investors were absolutely terrified that these new autonomous AI agents were going to come in and just kill traditional per-seat software licenses entirely. No more human workers, no more software seats, right?
So to completely dismantle this market myth, we're going to break down ServiceNow's anatomy in 5 quick steps. AI software doomsday, corporate digital hub, compute billing revolution, giant's moat, and finally, the flywheel and compounding financials. Section 1. AI software doomsday. Investors were terrified of a really simple piece of logic. The idea was, hey, if generative AI and autonomous agents start doing the actual work of humans, companies simply aren't going to need to buy as many software seats. Since ServiceNow traditionally made its money by charging per human fulfiller, think of an IT support worker or an HR rep sitting at a desk. Wall Street just assumed their entire business model was essentially doomed. Poof, gone. Moving on to Section 2, Corporate Digital Hub. Here's the crucial thing you have to understand. ServiceNow isn't just some app you can easily uninstall when you get bored of it. Think of it more like the corporate central nervous system. Instead of having different departments using totally fragmented software and completely disjointed data, ServiceNow steps in and connects IT, HR, and customer service into one unified brain. That deep structural integration is exactly why they have a mind-blowing 97 and 98% customer renewal rate. Once this thing is deployed, it literally becomes the lifeblood of the organization.
And look at how they're evolving that platform specifically for the AI era. They aren't just slapping a basic chatbot on top and calling it a day. They're upgrading in tiers. They move from basic AI helpers in their foundation tier, stepping up to advanced coordinating agents, and finally hitting Prime. In that Prime tier, autonomous AI specialists basically act like virtual employees. We're talking about AI capable of executing really complex, multi-step workflows across different departments totally on their own.
Which brings us to Section 3. Compute billing revolution.
So, if you have virtual employees, how do you build for them? Well, ServiceNow is navigating this transition absolutely perfectly. They're moving away from strictly charging per human fulfiller and brilliantly shifting toward a consumption-based model. Enterprises now buy assist packs, or essentially tokens, for the raw compute power and the automated tasks that these AI specialists consume. It's kind of like just paying for the electricity your virtual workforce uses to get the job done. And the market is totally validating this shift. Customers are willingly paying a massive 30%, and sometimes even up to 60%, pricing premium just to get their hands on these generative AI Now Assist capabilities. The productivity and efficiency gains are so undeniably good that companies are happy to fork over that premium. That gives ServiceNow incredible pricing power right now. So, far from destroying their business, the AI revolution is actually allowing ServiceNow to directly monetize corporate automation. They no longer need a human attached to every single license to keep growing their revenue. They are now directly monetizing the actual value and output of the work being done. It's a total game changer.
Section 4, Giant's Moat. Let's see how they defend this turf.
When you look at the competitive landscape, there's a really clear strategic divide. You've got Microsoft trying to win by bundling their Copilot AI for free or super cheap, mostly relying on unstructured data, things like emails and Word documents. Then, you have Atlassian disrupting the mid-market with cheap, fast-deploying IT tools. But ServiceNow? They command the premium Fortune 500 market because they own the complex, structured workflows. And here is ServiceNow's ultimate defense against Microsoft's bundled AI, the context engine. Because ServiceNow has billions of past executed workflows and incredibly strict configuration databases, their AI doesn't just guess or hallucinate answers based on some random email thread. It provides reliable, rock-solid, actionable business logic based on how the company actually operates in reality. It's grounded in facts.
Now, to expand that moat even further and really protect themselves long-term, ServiceNow made a highly aggressive move. In 2026, they dropped $7.75 billion in cash to acquire the Israeli cybersecurity firm Armis.
Wall Street initially balked at that massive price tag, but the strategic vision here is huge. By bringing in Armis's ability to defend physical IoT devices, factory equipment, and even medical devices, ServiceNow is expanding its total addressable market to a staggering $600 billion by 2028. So they're moving way beyond just the digital brain and starting to protect the physical limbs of the enterprise as well.
Finally, Section 5, Flywheel and Compounding. Let's talk numbers.
Okay, let's dive into these super ambitious 2030 targets. Management is aiming for an incredible $30 billion in revenue, which would effectively double their current size. But what's even more impressive is they're targeting an ultra-rare Rule of 60 plus. In simple terms, that means maintaining over 20% top-line growth, while simultaneously printing massive free cash flow margins of over 30%. It's basically the holy grail of software metrics.
But we do need to be totally impartial here and point out the fundamental weakness. There is a massive gap between their GAAP and non-GAAP margins, and that's caused by billions of dollars in stock-based compensation. To keep their top engineering talent, they're heavily issuing stock, and that significantly dilutes real shareholder returns. It's a very real cost, and investors absolutely have to factor that into their long-term calculus.
Even with that dilution, the current market mispricing is stark. Because of that initial AI panic we talked about earlier, ServiceNow is trading at roughly the same valuation multiple as Microsoft, despite growing significantly faster. And when you compare them to legacy giants like Salesforce, whose growth has slowed down to the single digits, ServiceNow's compounding flywheel looks incredibly robust.
So after unpacking their brilliant transition to consumption-based billing, that impenetrable context engine, and their massive ability to just generate cash flow, the narrative really shifts, doesn't it? AI is clearly not their doomsday, it's a massive catalyst. I'm going to leave you with this final question to ponder. Is ServiceNow just an overpriced legacy software, or are we actually looking at the completely undervalued, indispensable operating system of the AI future? Thanks for exploring this with me today.